And now we're going to talk about how you identify and possibly how you save, not universities, but entire countries. And indeed, question is the survival of the euro itself, which I think it is not an understatement to say is very much endangered today. All you have to do is pick up any newspaper, whether it be even a financial or non-financial, and you read about the crisis that's going on. And it's clear, it is the #1 crisis in the world today. At the same time, we are enjoying, in some parts of the world, like your country, and to some extent my country, an almost unprecedented, easy situation with respect to credit, debt markets, and the like. What I'd like to do is present to you some new research and thinking, hopefully new thinking, on this topic. And as Magnus mentioned before, your institute here is more microeconomic oriented, and indeed, my research has been more micro-oriented for most of my career. And then about a year and a half ago, I began to look more interestingly at what was going on a macro global country level, and think about why have we failed, both as researchers and as policymakers and as macroeconomics economists, to identify problems in the sovereign area, as we have not failed, I don't think, in the company level. Indeed, the models that I built and others over the years have generally performed quite well with respect to company distress and default prediction. My good colleague Lars Oxelheim knows this very well, as we've talked about this over the years, and he is, by the way, mainly responsible for me being in Sweden this week. And we were discussing why have this not been the case with respect to sovereign. Just think back. When was it? In 2009, when we began to see that maybe there was a serious problem in Greece and perhaps other so-called peripheral southern European countries. Why? And by the way, I'll show you the data. The rating agencies were all giving very high ratings to all of these countries. High investment grade, AA, single A plus ratings. And yet, we began to worry about it when some macro data that we had been using in Europe, the so-called deficit to GDP ratio, was thought to, however, been much higher for Greece than ever before. That was the first warning signal, and it came in early 2009. And look what's happened since. It's gone from a question mark to very much where just about everybody except the politicians in Europe are saying that Greece will fail, will default. And I am in that camp, and I have been for at least 6 months, saying a default in Greece is inevitable. And indeed, I don't think there's much you can do about it, even though everyone is trying. And we'll come back to that theme. Now, why this idea, maybe I'm in the way here, of a bottom-up approach being the way to look at sovereign risk as an alternative way? And let me give you one anecdote that for me was most important in framing this type of research. And I go back to 1996. And if you recall, there was a crisis in a region in 1997 and 1998, very much like the crisis now in Europe, with some, of course, differences. There was no euro then, but it was Asia. Maybe you recall the Asian crisis of 97 and 98. And do you remember where it started? Thailand. And then it went to Indonesia. And then it went to East Asia and other countries. And there was a big debate then as to what caused the crisis. Was it macro-related factors such as funds flows, the Western countries taking their money out, forcing a devaluation of the currency? Or was it micro, in other words, the individual companies and the health of the economies of each of those countries? Well, the World Bank did a study back in 1998 as to which countries looked the most risky prior to the crisis. In other words, nobody was ready for the crisis yet. But if you have looked very carefully at the health of the private sector in each of these countries, what country would you believe had the highest default risk on an aggregate basis for each of the private sectors in these countries? Think yourself, what country was most risky? Well, many people would probably have said Thailand or Indonesia. Very few would have said South Korea. And yet, I see somebody nodding his head. So you would have said it, and I'm glad you didn't, because then I wouldn't be able to say it before you. But the point I want to make is that South Korea, by the way, AA- on December 31st, 1996, had the lowest Z score, which is one of the models we built, like you mentioned, in 1968. And if you then looked at the average or the aggregate for companies in all the Asian countries, South Korea had the lowest score and the highest probability of default. And yet it was AA- from Standard & Poor's and similar rating from Moody's on that date. 6 months later, BB-, and except for a bailout of $50 billion from the IMF, South Korea would have defaulted probably in late 97 or 98. And this I remembered and didn't do anything about for a long time until about a year and a half ago when I began this research. What I'd like to talk about in the brief time I have with you today is a very quick motivation on current conditions in the United States, in particular in credit markets, and how that's relevant, and particularly what are the potential storm clouds on the horizon that could change the way capital markets operate again. It's absolutely amazing, and this is really a subject of a different speech perhaps, how quickly we forget crises and how things change, in this case recovering so quickly and so robustly. And now we're beginning to build perhaps another bubble in credit markets because of the very low default rate, the very low interest rates, the easy credit, and the amount of debt that is again coming into the system. I will not have time to mention much about Argentina, but particularly Europe today, and then mention one thing before we get into the actual model. The traditional indicators of macroeconomic problems, debt to GDP, deficits to GDP, unemployment, productivity, trade deficits, and the like, simply do not give you an early warning. They confirm what everyone already knows, and then the next question is, how bad will it get? And that, of course, is very relevant to what's going on today. I might mention in passing there are a number of academic works over the years looking at sovereign defaults. None of them are being used. There must be a reason for that. Either they are not very good models or people don't understand how to use them. And I think it's really the former in most cases because, nobody has a patent on the complexity of these models. And then they introduced the so-called Z-metrics approach that I worked on in the last 6 months to build us up to this point. This data shows you very quickly the default rate among corporations in the United States over the years. And usually we always find a big peak in default rates during recessions. And these are the 3 recessions we've had in the US, double-digit default rates, and each time you've had these big spikes in credit problems, you had an amazing recovery following it, where the default rate falls very quickly, the return on risky assets is excellent, whether they be in distressed or so-called high-yield bonds, and then we are then again in a benign situation, as we are today. The last year and a half, the default rate on very risky debt in the US, and I'm using the high-yield bond index, is about 1%. 1% of risky companies default on an annual basis, as opposed to an average annual rate of about 4.5%. So way below the normal situation is the way we're in the situation today, after this nasty crisis we all lived through in 2008 and early 2009. This is the situation today with respect to yield spreads. That's the rate between high-yield bonds and so-called risk-free treasuries, 10-year T-bonds. They reached a low in 2007 when everything was wonderful, but of course the bubble burst. It went as high as 2,000 plus basis points, or 20% spread, unprecedented in the modern economic world that we live in, and then dropped like a stone. Today, about 400 basis points. That's 125 below the historic average, and about 125, 130 above the all-time low. So, here's the scenario I'd like to present to you today. We are in this benign credit situation, at least in the United States, in many other countries, on a microeconomic basis, and a fairly decent but now stagnating growth rate in the economy. Here are a number of bullets that represent the potential storm clouds going forward. And I'm only going to concentrate on one of them, and that's the second one. But let me just mention, the first one is also important, and that is the possibility of a renewed recession in major countries of the world, or a big drop in the growth rate. Today, I would say the probability of a recession in the United States, again, in the next 12 to 18 months, is about 25%. Now, that's up dramatically from under 10% about a month or two ago, and about the same that people were saying 6 months ago. But it's non-trivial, because we are beginning to stagnate in many different ways. Still, there's tremendous opportunities to grow, and most economists, the macro folks, are saying we will grow again at something like 3 to 4%, which is decent growth for us, in the next year or two after this year, 2012 and 13. That will cause a problem, of course, if it deteriorates further. But it's the sovereign debt crisis, and particularly in Europe, that I want to focus on. Now, I'm going to go very quickly over the so-called model, but just explain to you what we're talking about. About 100 years ago, I built my first model. Oh, thank you for laughing. But it was a long time ago, right? Actually, it was about 45 years ago. I was 7 years old at the time. We built our first model for predicting financial distress, called the Z-score model. And basically, it looks at fundamental factors of a company's performance, leverage, profitability, liquidity, and the like. It's a multivariate approach, assigns weights to the various measures, and comes up with an overall score, which then can be translated into a probability of default, usually over 1 or 5 years. I choose the 1 and 5 year horizons because it's consistent with the way the modern credit world looks at default risk today, particularly in a market which some of you are familiar with, maybe some of you are not, called the credit default swap market. It's an insurance premium market where you make a bet on whether or not a company or a country will default, and you pay an insurance premium to hedge against that default. That's the CDS market, 1 and 5 year contracts. So the Z-score model, now updated through this new model called Z-metrics, which looks at fundamental financial and economic factors, market value of the company's equity relative to its debt levels, and macroeconomic factors, all in one model, coming up with an overall Z-metric score for the company. That score can then be transcribed into directly a probability of default, a so-called PD. What we've done with respect to country risk is aggregated every company that we could find data on, which are mainly the listed companies, and assign an overall probability of default for the sovereign equal to the median 50th percentile firm in each country. That's arbitrary. I could have chose the 75th percentile, the 90th percentile, but we just chose the 50th percentile as an indicator of risk of countries. So I'm going to skip over the ingredients of the models. For those of you who like math, this is the transformation from the credit score to probability of default. It's called a logistic function. Show you some background data now before we look at our results. This is Greece. Vintage 2009, A1 rating. That's the highest of the A ratings. Not as high as AA and AAA, but a reasonably good risk. Nobody was concerned with Greece defaulting here. Almost no one. Stayed that way until the beginning of 2010. Then dropped to A2, A3, BA1, B1. Now it's probably even lower. It might have been dropped since the last time I looked at it. Now everyone is concerned with Greece. Portugal. Look at this. Started at AA2, even higher. Now at BA1, which is still investment grade. Ireland, starting at AAA down to BA3. The rating agencies we know are going to be slow. By their nature, they are slow and rigid. They don't want to make a mistake by being too low and having to raise it. Spain, AA2 still. If you look at the probability of default of Spain from any rational standpoint, you could never justify these ratings. Now let's take a look at a number of countries. Let's go back to 2008, the end of the year 08. These are the median, that's the 50th percentile, probability of default, starting with the two lowest countries, Greece and Portugal, the third being Italy, and I'm going to come back to Italy at the end, the fourth being Spain, and Germany even was high at this point. Germany, don't forget, was coming out of their own economic problems. Sweden, decent, but not terrific. Then things improved at the end of 09. Again, the same median measure. Still, we have Greece and Portugal at the bottom, followed by Italy and Spain. But now most of the countries, except for Ireland, were beginning to improve, mainly because the stock market in these countries improved. And whenever you have a rising stock market, you have a lower probability of default and a feeling of confidence, and that the future is going to be more optimistic. At the end of 2010, just a few short months ago, only Greece has deteriorated to now that the median probability of default is 15%. Portugal is still high, and then there's been some improvement in Italy. Spain has deteriorated. Sweden now is looking quite good, and I'll show you the rankings of these in a moment. But the basic point is, even back here at the end of 08, a microeconomic measure aggregated for the country. Incidentally, why is it so important to look at the private sector of these countries as their ability to repay their debts? Well, who pays most of the taxes, at least theoretically? It's the companies, besides, of course, the people. And the people work for companies. If their companies are doing poorly, they can't pay the taxes, they can't hire the workers. So think about the normal type of austerity programs that are put in place when a country gets into trouble, cut expenses, raise taxes. You need just the opposite. You need to nurture the private sector, not to penalize them. And it'll show up in their default probabilities if you do one or the other, I believe, as well. Let me just show you when you add banking firms. Incidentally, all that data was non-banking, non-financial companies. When you add banking firms into it and you rank, this is 2009, let me show you the latest data, 2010. If you would now rank the countries in Europe, the safest country in terms of default risk by our model is the Netherlands, followed by Sweden. And I'm not just saying that because I'm here. But it is true, at least from a private sector, and again, the caveat is, these are only listed companies on the stock exchange. It's the only companies I can get data on. My plea is that this technique will be embraced by central banks in many countries who have data on the non-listed companies, and to run some sort of health index on the entire infrastructure of the country, not just the listed companies, which, look how few you have in Greece. In Sweden. How many do you have here? 245. Well, it's not as bad as I thought, but when we got data on, but it's still relatively small. This is the CDS spread on Greece. Back when we were very concerned about Greece, it was under 20% probability of default. Still not low, and among the worst in the world. And then look what happened to the implied probability of default from the CDS market, dropping from 17% to under 10% 1 year later. When we were convinced that Greece was likely to default, the markets were not convinced. But now look what's happened. 77%, over 70% is now the implied probability based on how much you have to pay as a premium on your insurance against a default in Greece, despite the fact that the central bank and the IMF are committed to bailing out Greece again and again, because there's too much at stake in terms of the euro. And here's the last thing I want to say before, I don't know, how am I doing on time? Am I just about out? I'm -5? Okay, so let me just end with this last caveat. Think about the euro, and think about what's happening here. Everyone today is focusing on Greece, but Greece is under 3% of the GDP of the European Union. They're concerned with Greece because of the contagion effect to other countries. But how can Greece survive when you think about it? They have very few, if any, comparative advantages. They have enormous high costs, because they are tied to the euro. And they have an economy that is incredibly difficult to restructure in terms of social issues, in terms of fiscal issues, in terms of monetary policy, and particularly, you cannot devalue the euro. A lot of people are beginning to say the only thing that can save them is to go back to the drachma and then devalue the way Argentina did. And that's probably true. But the problem is not Greece. It's spreading to other countries. Well, it already has spread to Portugal. It already has spread to Ireland. So who's next? Spain. Spain is next. There's no question about it. And Spain has enormous problems. Unemployment over 20%, a real estate debacle. Most of the local banks are insolvent, if not all of them. Some of the big banks are probably not as healthy as they seem. But the point is that Spain is next. And whether or not they need to be bailed out is a relevant question. There'll be possibly an editorial tomorrow, Financial Times, where I argue, however, that it is not Spain that is the key, it is Italy. If it spreads to Italy, which I think it will, Italy, by the way, AA country, much stronger than all these other countries. But Italy has $2 trillion of government debt. Spain about 600 billion. Greece 380 billion. So Italy is far, far greater in terms of size. Will the European Union be able to rescue Italy if it gets to that point? I don't think so. I don't think the voters in Finland, in Germany, and other countries will permit it. So Italy, I believe, is the fulcrum country. Fulcrum meaning a country right here, could fall either way. Italy's much stronger. Probably will survive and will rescue the euro, will be the hero. But if it falters, in our opinion, the euro is finished. And if the euro is finished, it means terrible things for the rest of the world. It's not just a European problem. With that, I will, with that happy note, I mean, there are some fluxes out there. Believe me. I have some ideas on how to, maybe we can do in the Q&A, of what we can do to help these countries. But I just don't think throwing money at them is going to do the trick. At least not in my opinion. Thank you very much.
For just a second, I'll just give you some
follow-ups
on this. First, I recommend everybody who is interested not only in the math but also in the model to have a look at the paper, which is supplied downstairs and is here.
Oh, you've all read the paper. I could have gone.
It's available, but just to understand the Z metrics, which is your development here of how to foresee prices in the future. You are pretty sure personally, now you mentioned it and you showed the CDS books that Greece will default. But at the same time, the Z metric shows 25% or 30-ish, yeah.
No, about 15% is the median probability default of a Greek company today.
Yes.
But that's the median, the 50th percentile. If you go to 75, 90 percentile is much, much higher.
What is sort of the cutoff limit for you for if one uses Z metrics in a policy environment?
Well, looking back to 2008, the end of 2008, those countries with 10 or more looked like they were in serious danger. 10% or more, the median. But, you know, it's a very good question, Martin, because I've never done this analysis with respect to predicting what's the tipping point, if you will. I was only looking on a relative basis rather than an absolute basis as to what determines the point where you are worried about the sovereign. And I must say, and this is really an idea for the future, probably the best way to attack sovereign risk is to combine macro and micro, not to just do one or the other. So what I would do is look at the usual suspects, so to speak, that are the macroeconomic factors, and then add some sort of measure of the health of the private sector as an additional primary variable to build that final model. I don't think we're there yet. This is just a step, hopefully, in the right direction.
And just before I let up, Karolina, you're pretty harsh on the rating agencies. Why are the markets not using for their own benefit more of those?
The markets know that the rating agencies are going to be slow. It's in their nature. Here's my opinion of the rating agencies, and there are lots of aspects that things they do well. I think they do quite well on the rating of initial public offerings of plain vanilla bonds and loans of companies. Incidentally, I remember coming to Sweden the first time, and at that time, Standard & Poor's bought the rating agency, I think that was constructed, if I'm not mistaken, by some students or graduate students from the University of Stockholm's Stockholm School of Economics. And they added them to their global expansion. Here's here's the basis of rating agencies and why you never should rely on them to be fast enough to capture the downturn of a country or a company early enough. They have a built-in stability of the ratings, meaning that they do not want to make a change, particularly a downgrade, until they're sure that the next change after that will not be in the opposite direction. So if it's going to be a downgrade, they're pretty sure that if there's going to be change later, it's going to be also another downgrade and not an upgrade, because they don't want to have this sharp tooth type of trend. Second, who pays the rating agencies? The issuers. And issuers prefer stability rather than volatility in the ratings. That's why a market measure is always going to be, if it's a decent one, or a model, going to be more quicker and probably more accurate in terms of predicting default. It may not be more accurate in predicting upturns.